Now, the reality is that so far we've been pretty vague in relating the initial capital injection, the $1,000 in stocks that we've raised, with the actual business plan of the company, what we're actually planning to do. I mean, if you remember, we're planning to sell some ice cream. The reality is that, why would anybody want to invest $1,000 in our business in the first place? I mean, if we're planning to sell up to 40 units of ice cream by the N4 of operations, this is not a very exciting business to invest in. So now we're going to start tying up the concept of capital injection with the business plan that we have, right? The reality, if you want to sell some ice cream, is that you're very likely not going to sell 10, 20, 40 ice creams. Like, you're likely going to want to aim for higher values, somewhere around 1,000 ice creams the first year, 10,000 ice cream the second year, maybe even 100,000 ice cream the third year. And who knows, if you really manage to scale up operations pretty well, you're going to want to sell like a huge amount of ice cream by the year after. I mean, now you see that our year-on-year growth is quite different. It has a pretty different profile. The revenue profile that we have as well is quite different. And essentially, kind of like the final numbers, for instance, the equity value that we have in a company by year 4 is significantly different. Fundamentally, the mechanics is still the same. So the mechanics of our company is still the same, and so a lot of the ratios that we've started talking about are still fundamentally similar. Our return on equity is still, let's say, quite positive. But now the question is, okay, if we're actually planning to sell up to 1 million units by year 4, what is the initial capital injection that needs to happen to be able to do that? Well, the reality is that we're going to have to invest pretty heavily on a lot of the cost structure that we had in place. We're going to have to invest not just on operating expenses like marketing and labor and stuff like that. We're very likely going to have to invest in machinery, just like actual capital, significant capital that we need to invest, fixed capital that has a fixed cost that we can amortize or deprecate over time. For instance, an ice cream machine or whatever. I know nothing about ice cream, so I don't know what kind of machinery is actually needed. But you get the point that I'm coming to. This is what a table like this is usually important, an investment table. The reality is that deciding what is the initial capital outlay that you need to be able to get your business started usually depends on the future stream of revenue that you can expect from that very specific business. So the way that we're going to kind of like think through how much capital we need to allocate at first is we're going to grab our unlevered free cash flow, which is essentially coming from the 4 years of upcoming operations from the company, and we're going to do a very typical discounting of these cash flows. This is a very standard method, discounted cash flow by the weighted cost of capital, weighted average cost of capital. So we're going to essentially gather up some estimates of what is the best alternative for the equity that investors put in business. What is the best next alternative that they can get, and what is the same alternative in terms of the cost of debt. And then we're going to compute this weighted average cost of capital that we're going to leverage to discount our future cash flows, and that we're going to leverage to find the net present value over 4 years of operations for that business. If we have a net present value of 5 million, it's very likely going to set a upper bound on whatever capex we want to outlay to be able to access this net present value, right? So how many machines we want to build and whatnot. You're likely not going to need $5 million to kick off an ice cream business. You're also not going to need $1,000. maybe a reasonable starting cost is going to be somewhere around 100K to be able to have kind of like the initial outlay needed. Now that would be a pretty healthy MOIC, pretty healthy return on invested capital if we manage to actually make this future cash flow happens for our business. Now, this $100,000, this is actually the value that we're going to want to raise. We could do it in debt, in stock, or a mix of the two. Here we could actually do maybe a mix of the two by actually raising $50,000 from debt and $50,000 from stock insurance. This is going to create a dual capital structure. So this is going to create a capital structure that relies on both debt and stocks equity to finance operations. I think there's a lot of people arguing on what is the optimal capital structure that you want in a company. You clearly don't just want equity, or you don't only want debt. The more debt is, the the best tax advantages you can have, but the more costly it is for your business, right? Because you need to pay back an interest rate to the debt holders, who also have a priority claim on the assets should your company go bankrupt. But raising only with equity is very, very dilutive. So if you're an owner of your company, of your ice cream shop, and every time you want to scale up your operations, if every time you do that you raise equity, well, you always have to give essentially more and more claims on your future revenue and profit. You're diluting away the equity stock that you actually own in your own business, up to the point where you might end up, even having a minority stake in your own business. And then, why do you wake up in the morning and go sell some ice cream if you do it for somebody else? So again, there isn't really an optimal capital structure, or maybe there is. I don't know what's the latest on that topic. The one thing I know is that I don't really care. So I just really care about raising a healthy amount of debt and healthy amount of stocks to be able to have our initial outlay of capital. Now, that initial outlay of capital, as you can see, right now this is essentially just common stock. This is common stock that is present on our equity table. This is money that we've raised in cash. So for every dollar that we've raised in stock or in debt, this is essentially dollars that we now have in an account, right? We now have it in an account. As you can see from the cash flow statement, we've raised this money. It goes straight into an account, and now we can do something with that money. Now, what should we do with that money? Well, something we could do is, we could purchase some equipment. We can purchase some capital. We can literally invest in capex. Now, again, there's going to be some heavy machine that you're going to want to invest in should you want to scale up your ice cream business. But we're even going to start much with easier capital investments. If you don't have basic stuff like a computer, a phone, I'm a pretty big fan of AirPods to focus pretty well, iPad, tablet, it's going to be hard to do anything, to get anything done. So I'm just going to start with a very, very basic outlay of capital in these very fundamental assets that you can have. So on year one, I'm basically going to want to purchase a computer, purchase a phone, purchase some AirPods, and purchase, maybe an iPad and a tablet. So on year one, I'm going to want to make a 5K outlay of capital, which is definitely affordable, given the fact that we just have raised 100K capital. We're actually going to do it on year two, just for simplicity. So as you can see, that initial capital expenditure is really a cash outflow, right? This is essentially some cash that we had in our account that is now being invested in running the business. And so this is a cash outflow. It's essentially something that's going to impact our final cash at the end of the year negatively. It's going to lead to a lower value of cash by the end of the year because it leaves our account. But the reality is that when you do accounting, and again, this is where things starts to get very, very exciting. When you do accounting, you have to remember that the cost of machinery, for instance, needs to be matched to the moment that it helps generate a revenue, right? The matching principle, if I remember correctly. So when you really try to understand what is going on your P&L, you don't really necessarily want to understand what's up. You don't really want to know what's happening to your cash. This is what the cash flow is for. You just really want to have an understanding of the actual profitability of your business. This is really what the P&L is for. And so remember that even though we have a cash outflow associated with our first initial capital outlay in 2022, the reality is that we're going to spread that over several years of operations. Actually, we can even go here and look at our depreciation table. And we're going to see that it's going to take 5 years for a computer to be depreciated. In other words, a computer is going to help generate value and revenue for at least 5 years of operations. And this is why we have to match these expenses to these operating expenses to the 5 years of operation that it's going to be running for. So now things starts becoming interesting because it leads to one of the fundamental principle of financial intelligence. It's the idea that you need to understand that profit is not cash. These two things are very, very different. Even though you might generate a certain amount of profit, like 51K by the end of year 2, the reality is that the cash that you're actually generating by the end of year 2 is different. It's actually lower than that. It's lower than that because although the actual impact on our profitability is somewhere around $900, which is essentially the depreciated value associated with that year of all of the capital that we've invested in. So although that value is somewhere around $900, the real value of the cash that is gone, so that has left our account in 2022 is much higher, somewhere around 5x higher. And this is why the actual value of our cash balance by the end of year 2 is starting to diverge from the theoretical profitability that our business is able to generate on year 2. So this is really, really important to understand, because if you don't really understand that principle, then any deep dive, any financial deep dive that you try to do on any company, whether your own company or any company you're trying to invest in, is just going to be wrong, because you might mistakenly think that a company is profitable and that everything goes well, when in fact it's at a very, very high risk of seeing its cash being depleted and raising the alarm to get some very, very expensive debt that's gonna really kill your future profitability. So all of that is really, really important to understand. Amortization, depreciation, these are items that are going to make your profit diverge from your cash. And that occurs because you need to fund your operations, and it has an impact on the way that you account for that funding.